promote crystallization is simply the sponsor of a syndication earning their promote prior to the sale of the property, right? Now, why would the LPs agree to that? Well, that's what we're going to spend, maybe about 5 minutes today talking about that topic, and then we'll open it up to Q&A. So drop your questions in the comments, and then as always, we'll timestamp the question. So if you want to watch the replay, or if you're watching this for the first time, you can just go down to the timestamps and take a look at the questions. But this it's very similar to our episode 33, where we talked about the misalignment sometimes between the GP and the LP, where sometimes the LPs want to continue on the deal. It's a great deal, but there's a conflict of interest almost because the GP wants to sell, because that's how they get paid. They get paid when, the promote, which is the main form of compensation of a sponsor, that really doesn't get triggered until you actually sell the property. So there's this inherent conflict sometimes where the sponsor wants to sell to get paid, right? And it may not be in the best interest of the investors. It may not be the best move for the particular asset class. So promote crystallization is one of the ways you can fix this potential problem. And there's really three main scenarios. I've actually dealt with it in one specific scenario, but the three scenarios where it can really play a big role, there is in a 1031 exchange, where a syndication wants to just 1031 into another syndication, development deals, and even refinance. So let's go through those really quickly. The first one's the one I have the most experiences, because I've done these several times, and that's when you're doing a 1031 exchange. So just imagine you're doing a syndication, you've done a syndication, you've crushed it, you've added a ton of value, the property's increased, but instead of selling the syndication and everybody cashing out, everybody agrees that they'd like to 1031. And in this particular example, everybody had agreed. There's a couple that didn't, and we did a drop and swap and got them out, but everybody agreed that they wanted to 1031 into this bigger and better property. But of course, the issue becomes, well, the sponsor, how do you address the promote? Like let's say they do an 80-20 split. Well, I typically would get paid my 20% if I sold the property. And if we 1031, how do I account for that 20% of value that I've added? And so crystallizing the promote, meaning getting compensated for the promote now at that point, makes a ton of sense. And we're going to talk about the mechanism in a second of how it actually happens. But that's one scenario where it would make sense to actually get paid on the promote prior to the sale, because you're basically doing a 1031. Now with the 1031, what was interesting is you kind of have two promotes, right? You have the promote of the new deal. So the new syndication, it's an 80-20 split, but the original deal was also an 80-20 split. So that's one way you kind of address that particular issue. Number two is a development deal. That's really where I think most of these crystallizations happen, because again, you add a ton of value on the front end, right? After maybe 2 or 3 years, you've built this thing from the ground up. You've added a ton of value. It's worth a lot, but maybe it's a great asset, or it may well be a great asset. It's in a great market. It's a great cash flowing property. Like maybe you don't want to sell it, and the idea is to hold on to it for 5 or 10 or 15 years. But again, the syndicators done all this work, they want to get paid. And so, how do you do that without actually selling the property and continuing to hold the property for cash and moving forward? This crystallization of that promote, giving the syndicator their promote at that particular point, which obviously has to be pre-negotiated and figured out when that happens. But the development is another great example. And honestly, the refinance, I don't see too many of them happening in a refinance, but that also makes a ton of sense, because think about it. When sponsors do a cash out refinance and return almost all of the money back to the investors, or sometimes all of the money back to the investors make out great, but the GP, again, doesn't really get compensated at that point. The compensation still gets delayed and deferred until the actual sale of the property, which may not happen for another 2, 3, 4, 5 years. And so crystallizing either all of the promote or maybe a percentage of the promote and giving it to the sponsors at that point makes a ton of sense also for the refinance scenario. Now, the calculation is really where it gets a little bit tricky, and I'm not going to go into the details of the math. That gets pretty complicated, but the idea behind, or the way you would typically calculate a promote crystallization, is you would actually go through call it the mental exercise, which is obviously a lot more than mental exercise, but you're going through the exercise of going through the numbers as if you had sold the property, right? So you're going to figure out what the fair market value of the property is if you were to sell it, which is probably the biggest unknown, right? But you get a broker price opinion, you get an appraisal, however you figure that out. And you run through the waterfalls. You pay, your closing costs, you pay your lender, you pay all those closing costs, and then you return all the capital to your passive investors, and then whatever's left over, it's going to get split 80% or whatever the percentage is for the LPs, and then you're going to get that 20% or whatever your carried interest in that promote. And that number, which is calculated, maybe it's 200 grand, 500 grand, whatever that number is, that is the value that you're placing on that promote. And then that gets paid to the sponsor at that point. Now, most of the time it doesn't get paid as cash because there is no cash. And so it gets allocated as a sort of a contribution of capital into the syndication. And so there's a reallocation of the percentages. So maybe it's no longer an 80-20, maybe it turns into a 70-30 or a 65-75, 65-35, whatever the math is, you realign the percentages, but the promote is now gone because I've capitalized that promote. And also any preferred returns have been gone, right? So if the investors are getting a 7% pref, that's going to be gone. Upon sale, there's not going to be a return of capital first to the investors before the remaining of the split. At that point, you get the distributions based on the pro rata, sort of the pari passu pro rata of whatever the ending thing. So it's a reallocation of the percentages. Now you can do cash. Sometimes I've seen scenarios where you pay the promote out of cash flow, but the one I did was just recategorizing the percentages. We actually created a brand new class of shares because it was a 1031. We just created a class C, and that was sort of the promote that we crystallized. And then for the next deal, they still got their additional 20%. So if you're getting value from this video, obviously would appreciate a like and subscribe if you're watching this on the replay. But how do you do a 1031 from one syndication to another? Does everyone have to agree, and does it turn it into a tick? That's a great question. The ideal way to do that is there's two ways to do a 1031 with a syndication. One is to disclose it ahead of time in your documents, right? Where you say, look, the plan A is to sell the property or refinance, but at the sole discretion of the manager, we may reserve the right to 1031 into another property. Now, the challenge with that is that might be an issue for the LPs, because at that point it turns into from maybe a 3, 4, 5-year deal into maybe potentially a 10-year deal, or if you do it twice, maybe a 15-year deal. So it becomes a little bit harder to raise capital if you disclose it or have that as your plan ahead of time. And so the ones that I've done have always been in conjunction with all the LPs agreeing. Right. So even though it wasn't disclosed, because it wasn't an original plan, it wasn't like we didn't disclose it because we didn't want to. That wasn't even a thought when the documents were drafted, when we originally did the offering. But at some point, circumstances changed. The market was super hot. The sponsor said, hey, we want to 1031. They went to all their investors. I forget how many. There was a lot. I went to like 30 or 35 investors. And they just had one-on-one call and said, look, this is the plan. We want to buy this new property. We'll roll everybody over and we're going to crystallize the promote. And basically you run it through all of the LPs. And then they have to sign off. They all agree. It's basically it's almost like a material change. And so you want everybody to kind of sign off and vote. At least that's our opinion. And you want to have sort of a unanimous vote on that plan because it wasn't disclosed originally. And inevitably, there's going to be 1 or 2 or 3 or 4 or 10 people that don't want to do it. They want to cash out. They want the money now, and that's fine. And that's when we got to figure out what the drop and swap mechanism is going to be, and that's going to be dependent really on the specifics, the facts and circumstances of your specific syndication of where you are. Do you have cash? Just however you're going to structure it. So on this particular one, we did promissory notes, which I think is the way that most people do it, and I think every single drop and swap that we've done has been through the use of promissory notes. Tim, is there a difference between funds of funds and regular fund structures? There's a huge difference. I'm gonna promote my YouTube a little bit. If you go to, I think it was 4 videos ago, I did the presentation for Tim May over at the Hero event, and this is the exact topic. So it's a 25-minute keynote presentation I did. It's on my YouTube channel, so I encourage you to look at that. But the main difference, and I'll highlight the main difference here, and it's a critical one, and a lot of people just overlook this. But when you're doing a regular, assuming it's a real estate fund, when you're doing a regular fund, you are investing in real estate. So you're raising capital. So we use 506B, 506C, Reg A, whatever exemption, and then we're deploying the capital by buying real estate. You don't need a license to go buy a piece of real estate, right? You don't have to have a real estate license to go buy a piece of property, right? But when you're doing a fund of funds, you're actually buying shares in somebody else's company, right? They're actually LLC units, but I'm buying a piece, an LP interest in somebody else's syndication. So now I'm in the business of buying a security. So I'm raising capital under 506B, 506C, but I'm raising money into 506B, but I'm actually buying a security, and that opens up a few other regulatory issues, which is why I mentioned the cost over to Kathy. The cost goes up a little bit, but now you've got to worry about investment advisory rules, because you're an investment advisor. Because again, you're advising your fund as to the purchase of securities, as opposed to advising your fund as to the purchase of real estate. So that subtle difference makes a huge impact. And you've got to worry about Investment Company Act. You've got to worry about broker dealer rules, and you've got to worry about registered investment advisory rules. But check out that video on my YouTube channel, because like I said, that's the hero event I did for Tim a couple months ago. And that's all I talk about. Wook Chung, on a JV with 5 partners where 3 of them will be hands off. That doesn't sound good already. If they're hands off, they sound like passive investors to me, but let's continue. On a JV with 5 partners where 3 of them will be hands off, how can the partnership be structured, or what type of article can be in place to give decision rights only to the 2 active partners? Okay, there's really 2 angles to this question. So let me ask the one that you're probably looking for, and then I'm going to give you the answer to the concern I have. But the mechanism to give the 2 active partners, that's easy, because a joint venture is usually just an LLC. Right? The joint venture, let's say you have 5 partners. The way I would be structuring that is that I have an LLC with 5 LLC members, right? And so you can always have 2 of them become the managers of that LLC, and they have all the voting, they have all the voting ability to run the day-to-day, So that's just going to be in the operating agreement for the joint venture entity. That's going to say, hey, in joint venture 1 and Bob and John are going to be the co-managers of this LLC, and they're going to have all the authority to do all the stuff. They're the day-to-day. That's just going to be in the JV LLC. And then of course there's going to be either a management company that'll run it, or maybe just the 2 individuals, but that's just going to be a corporate thing in the operating agreement. The concern I have the minute I see that is that when you have 5 partners, 3 of which are active and 2 are passive, or the other way around, 2 are active and 3 are passive, hands off, that's a security, right? So that's the textbook definition of a security, which makes that a syndication. So the 2 active partners are really the sponsors, and they're doing a syndication, and they've got 3 passive investors. Again, not the end of the world, but now you've got to find an exemption or register it, or it's illegal, right? So may or may not have to do a PPM, but it's certainly a securities offering. So the way around that with the JV, the easiest way around is just to make all 5 partners active members, right? If all 5 are managing members of the LLC and they're all making decisions based on their percentage ownership, then boom, you've left the realm of being a security and everybody's actively involved. And so that's a true joint venture. But when you have 3 passive investors or hands off, then that starts to look a lot like a syndication or securities offering. And now you've got to comply with the securities laws. But in terms of just, making the 2 people, the day-to-day decision rights, then that's just something you incorporate into the operating agreement. Yeah. So what you're talking about is let's call it a vulture fund or distressed fund for lack of a better. We were taking a lot of calls with vulture funds back with COVID days. Everybody thought everything was going to collapse during COVID, so they all were preparing for these vulture funds. But the idea would be, this individual is raising money to have money in the bank ready to go, or commitments ready to go, that when they see blood on the streets or somebody flailing and they're about to lose the property of the bank, or they're going to go PK, they can come in and quote unquote rescue the deal. How that is structured is going to determine how everything works, right? So they may just come in, for example, with a loan, right? They may just come in and say, hey, we'll loan you $1 million. We want a 15% return, and we'll be below the lender, but we'll be above your equity investors. And then maybe there's a second loan. So that wouldn't affect your structure at all. Most likely they're going to come in as preferred equity, which is going to severely dilute, if not completely eliminate, depending on where you're at, the equity for your investors, right? They're going to come in and say, I'm going to give you $1 million. If it wasn't for me, you'd lose all your money anyway. So I'm going to give you $1 million. I'm going to have a preferred equity position. And again, that's all negotiated, but that might dilute your investors to the point where they're going to end up losing money anyway. And again, it just depends on how the deal is structured or how bad the deal is. But if you're getting rescued money, you're a sponsor of the distressed property, I mean, the odds of you, well, I'm gonna say at that point, the odds of you getting compensated are pretty low unless they just come in, save the project, inject the capital, and then things get turned around and it sells in 5 years and the property is profitable. Then you might end up getting a little bit of a thing, but it's just a separate deal. The fund's going to come in and negotiate whatever they're going to negotiate, and it just depends on how distressed you are, how willing is your bank, for example. I mean, I was reading an article the other day where I think somebody posted on, I think it was Hunter Thompson's event. So somebody made a presentation at Rainfest, and there was some stat that said a third, I think it was something like a third of all loans are coming due this year are underwater and won't be able to be refinanced or getting a new loan. And they were talking about they're expecting a lot of the banks to start working with them, doing these loan mods as they did, back in the great financial crisis. So if you're working with a lender who's willing to loan mod, then you've got a little bit more leverage on the private equity group that's coming in and offering you $1 million to save the deal. The terms that you have with the lender may be better. But on the other hand, if the lender's like, no, you're going to lose the property, or there's no way you for whatever reason, we're just going to foreclose on you anyway. And so you're going to lose your money, investor money, everybody's going to go down to zero, then you're going to be more willing to take whatever onerous terms private equity comes in with. But my experience is, forget about the distress level. My experience is when private equity comes even before the close of a property, when somebody's struggling to finish the raise, those terms are really onerous. They're not good terms, right? Private equity is great on the front end when you're negotiating, when there's no pressure, but when you're struggling to finish the raise, those terms are onerous. You can only imagine what terms you're going to get on distressed property. They're not going to be very comforting terms. You're basically facing, do I want to just go into bankruptcy and lose the property entirely, or do I want to take this investor money there? And by the way, they're going to probably come over and take over either if they don't take over the management of the property with the lender's approval, they're probably going to have some major veto power. Like they're going to come up with a plan and say, if you fall below this threshold, we're going to come in and manage it. So it's going to be a facts and circumstances scenario, but it doesn't really overthrow your deal. It becomes part of it, but it's going to most likely dilute that project significantly, where investors may end up losing a significant amount of money anyway. It's just they're not going to lose all of it, because assuming they can turn this project around. But again, the preferred equity, private equity, they're not going to be interested in saving your investors' money or saving your money. They're just going to be interested in coming in there, stabilizing the project, and they're going to want to get out. Either you can buy them back out, or they're going to sell the asset and they get paid. It's almost like a foreclosure. Like, yeah, theoretically, if you're in second position, you might be able to get some money, but they're just going to sell it at the price that makes sense for them to get their money out with their targeted profits. Does that make sense?
Yeah, I'm just an LP in these deals, so I'm just seeing how that would affect me.
Yeah, you're gonna get. I think you're gonna get diluted. That's most likely what's gonna happen. They're gonna come in with a special class, A+, and they're gonna put the first monies in, but they're gonna get first monies out, and it might be a short-term deal. And if you can't get them out in a year, they're gonna take over the project, and they're just gonna liquidate in order to get their, let's say it's $1 million and they wanted to get a 20% return, then they're gonna liquidate it so that they get that 1.2 million, and that's all they care about.
Right,
but there's a lot of those going out there for sure. There's a lot of those that I think are going to start happening. So sorry to hear that, because that's coming.
No, I don't have a deal that's happening to.
You're an LP in a lot. You're an LP in a lot of these deals.
Yeah, I just was
got it. Yeah,
that would work if it did happen. So that
I don't have. Let me put it. It ain't going to be pretty. I'll tell you that. They're not going to come in with beautiful terms. Anyway, I have a few questions regarding the Form D required for 506B offerings. If the syndicator forgets to file or files late, good question. Do I, as the LP and the investment, have any exposure? No, zero. First of all, failure to file a Form D does not blow your exemption. So I want to get clear. That's the position of the SEC, right? It's not a prerequisite for the exemption, right? Now, the states disagree. Some of them. Some states are notoriously hardcore, and they'll write you a nasty letter. And I won't say you, they'll write the issuer, the syndicator, syndication LC, a nasty letter saying, you've violated securities laws, you've blown your exemptions, we're going to come after you, blah, 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 blah. That's all nonsense. What ends up happening is you end up paying a fine, and it's just a lot of headache. But the SEC has made it very clear that failure to file a Form D does not blow your 506B exemption. Now, that doesn't mean you shouldn't file it, because the states can still ban you from raising capital in their state. I mean, there's a lot of things that they can give you a cease and desist. The states have a lot of power, but it's not going to blow your exemption. And certainly the LPs had zero exposure on there. But make sure you file that Form D so that you don't get into issues there. Specifically, loss of capital due to some consequences brought about by either the SEC or the state securities. So even though there's no liability exposure for the LPs, I mean, if there's a fine or there's money that needs to be paid to the SEC or the regulators, and let me give you an extreme, ridiculous example. Let me just give you a thought experiment. But theoretically, if the regulator comes in and you're late and you want to decide to fight it, and you end up spending $100,000 on legal fees to go to trial and fight the SEC, and then that's $100,000 that the project has less, which is going to obviously affect your distributions, but it's not going to affect liability exposure for you. It's just going to potentially have consequences from just less money left over, because there's going to be fines and penalties. And if the syndicator, for whatever reason, decides to fight it, then whatever it costs to defend yourself is going to come out of the LLC, which is going to come out essentially out of your pocket. But from a liability standpoint, absolutely zero. What is the consequences for not filing or filing late? So at the SEC level, there's no late fee. So we've had situations where I've had new clients that haven't filed Form Ds on prior deals, and we just file them late on the SEC side, 2 years, 3 years later. It's really it's not the end of the world. But the states, there are late filing fees, and some are minor, some are major. And like I said, there are certain states, I won't name any, but there's probably 4 or 5 of them that are notorious, that they'll send you that nasty letter and just claiming all that stuff. And you're just going to end up spending some of your time and energy and money in responding to the regulator. But it's usually the states, not the SEC. Can the SEC charge a violation of securities laws by improperly selling unregistered securities and call the investment into receivership? No, because again, the failure to file a Form D does not blow your exemption. So from the SEC standpoint, that's not going to happen. Some states will allege that, but in my experience, you end up literally paying $1,000 fine plus interest, and they call it a day. From my Google research, okay, solid. From my Google research, it appears the syndicator is supposed to file within 15 days of the first sale. Yep. So the way the Form Ds work is that you're required to file the Form D with the SEC within 15 days of the first sale of your syndication, right? And that to me means money I would do it when money hits the account, right? When money comes in the account and they sign the paperwork, that's what I would use. Arguably, it's when you countersign the subscription agreement, but let's not cut it that close. And then each state requires you to file a copy of that Form D that you filed with the SEC. A copy of that Form D gets filed to each and every state where you have an investor, and that is due within 15 days of the first sale in that particular state. So my SEC filing may be due today, but maybe my first sale in Montana doesn't happen until June 1st. Then my Form D copy to Montana is going to be due on June 15th. So there's one for each and every state. It appears many syndicators don't follow this requirement. I've come to see that. I can assure you that all of our clients do, but I have come, and obviously I meet a lot of syndicators at all these events, and I do know that some of them come to me a little concerned, but yes, not everybody files a Form D, even though they should. I had one syndicator tell me their attorney was going to catch up on the filing soon. This is after the deal was funded, asset purchase and distributions have begun. Again, my capital risk exposure to me. Again, you don't have any risk as an LP. There's really it's not a huge deal at the SEC level, unless you get caught with your pants down, so to speak, and there's a claim somehow before you file the Form D. But you can always file the SEC late. It's the states that'll give you some heartache and some late fees, and some of them might be $300-400. Some don't have a late fee. It just depends on the states. And the last question then on Form D would be state filings. My limited understanding is that the state filing is required in each state represented by an investor, correct, within 15 days of that first sale. Why would a filing go inactive? Why would a filing go inactive? I'm not sure what that means if filing goes inactive. What is the consequences of not having an active state filing, even though the LP is still active in the investment and the exposure to the LC? There's, again, no exposure to the limited partner. The exposure is the states will charge you a late fee if you file late, and some states will make a big stink about it and send you nasty letters, and you may even have to go hire an attorney if they really get nasty. And again, those usually get settled, but you may end up spending, again, you meaning the syndicator, may end up spending $1,000, $2,000, $5,000 on attorney fees and stuff to get it handled, and the time they spend. But from an LP perspective, there's no liability for the LP. The consequences are just that the LLC may spend money, which obviously dilutes your distribution if they do. Hey, a lot of questions. Good. Kathy asked, I meant total capital raise 1 million, or this is an old one. Sorry, Kathy, I think we already answered that, right?
Well, the way you had, I wasn't sure what you never really answered what the total, like, if you're going to create a fund of funds, you know, you did for minimum investment, which makes sense, you know, probably 100,000.
Oh, how much? Oh, how much?
The total fund that makes sense based on
$1 million would be at a minimum. I mean, you're going to spend 20, let's say 20 to 25 grand on the raise, right? Just on the legal and compliance. And so $1 million, that's 2% of the fund. So that starts to be okay. 5 million for sure. But, you know, my number's always been 600 grand, 700 grand. It's okay. But $1 million should be fine. I think $1 million is a lot of people say $1 million is the minimum. I could see it going even a little bit lower, but again, it's just, you have a flat fee of your cost. Your cost of compliance is flat, 20 grand, 25 grand, whatever that looks like. And so the more you raise, it just becomes a lower percentage, a line item budget, a lower percentage. So I think $1 million is fine if that's what you want to do.
Does that flat fee include all the K1s and all that stuff as well? Or
no, that's K1s goes from the CPA. So you got the CPA, you know, you're going to spend the CPA. I don't want to tell what it costs to get. It depends on how many investors you have and how many K1s, but that's going to cost you some money. I think I saw Justin in here at some point. So, you know, I think it depends on how complicated your filing is and how many investors are going to be, but that's going to be, it's not going to be $500, let's put it that way, right? It's going to be, I don't know, 5-10 grand to do the filing. So it just adds up. So now you're up to maybe 30-35 grand, which is 3.5% of your $1 million raise, which again, just depends on how much meat is on the bone.
Yeah, that's why I was wondering what other, I wanted to kind of know total costs of everything, so I wasn't missing something out that might be part of that.
Yeah, I mean, for a typical syndication, I always tell clients to underwrite if it's just a project specific. I would just put 15,000. I have a line item on your budget called legal and compliance, and I would just put in 15K. And then if it's a fund, it's probably closer to 20K. And then you have your LLC entity renewal fees, which is not a lot. It's usually a couple $100. And then, but you do have your tax compliance, you know, somebody's got to file a tax return, somebody's got to issue all the K1s. And that's, I would say, I would probably, again, talk to your CPA on that. I'm going to throw out a 5 to 10K number. But that's not, I'm not a CPA. Tiffany, I was told not brand using my Wyoming holding due to, oh yes, I was told not brand using my Wyoming holding company due to it being our asset protection. How do I go about branding my company? Do I create a new LLC? Yes. So this is sort of asset protection 101. I think episode 2 or 3, we did it on this, but you want to separate your brand, which is really your business. So you have you call it a branding company, which is great. But whatever your real estate business is, or whatever business you have, maybe it's a management, real estate investment company, whatever that brand is, where you have your website, where you have business cards, with that you're the public face, whatever that business is, that's a separate LLC, and that does all the business and holds no assets. That's how you're conducting your business, right? That's your management company, your sponsor company, your operating company, or whatever. And that's usually set up in the state where you live, because that's where you're doing business. Your holding company holds the valuable assets, right? That conducts no business. Ideally, nobody even knows it exists, right? And so that's the one I like, Wyoming, but Nevada, Delaware, there's a couple of those states that would make sense. And that's how you would hold your assets, whether it's your interest in a syndication, whether it's a piece of real estate, whether it's a piece of art, whether it's your precious metals, whether it's your stocks, whatever valuable asset you have would be held in the holding company, or actually most likely an LLC that's then owned by the holding company. But nobody should know it exists. I mean, ideally, you set up a structure. Privacy has a role, and ideally, nobody even knows. That's why the holding company shouldn't have your name on it, your favorite color, your kids' names, your acronyms. It should be called some random stuff that nobody would ever be able to tie back to you. But your branding company is going to be your management company, so to speak, or your operating company.